The whole world's in a very different interest rate environment today than we were just 2 short years ago. And for an investor, that presents opportunities, right? For the first time in a long time, we're getting a decent interest rate in our bank accounts. Bonds are paying a decent interest rate. And as I record this, we're actually getting a higher interest rate in banks than the current inflation rate. So even keeping your money in the bank for right now, I don't know how long that's going to last, is beating inflation. So that's a welcome change. But with any change comes opportunity, but also comes risk. And so that's what today's video is going to talk about. I'm going to talk about the trade-offs and guide you towards investments that have lower risk and are safer places to consider parking your cash. Okay, let's go for a walk and let's talk about this. And you know, the challenge and why I'm making this video is when there are changes like this, there's people in the industry who jump on the opportunity to say, oh, people are interested in interest paying investments again. And you know, they can offer us now an 8% interest rate, and they can do it with a fairly large company that might be a household name that we know about. But you know, just because it's a household name does not mean it's zero risk. So I want you to be careful, because there are what I call junk bonds, what others might call, you know, lower grade investment bonds or non-investment grade bonds, or again, junk bonds is the term I use. And I think junk is the right word for it. Now, if you have access to a lot of research, if you've been doing this professionally for your life, you know, maybe looking at non-investment grade bonds makes sense. But for most of us, it does not make sense. How do we evaluate the risk that we're taking? So just because it's a company that was healthy a decade ago doesn't mean it's healthy today. So I want you to be super, super careful. So some of the safer places to invest your cash, and I need to back up and talk about two of the main risks with bonds. Now, these aren't the only risks that are associated with bonds, but two of the main risks. The first one is creditor risk. And that is, you know, what's the likelihood that the person that issued the bond, the company, I should say, that issued that bond, is going to be able to pay it off in full? And so that's super important, right? A company can offer you an 8% interest rate, and in today's environment, that sounds super attractive. But the question is, how confident are you that you're going to get the return of your money in addition to the return on your money? The return on your money in this case is 10%, but the return of your money is much more important for me than the return on your money. So there's creditor risk that I just talked about. And then there's something, it's kind of a 25-cent word. It's called duration risk. So bonds that have a longer duration, for instance, a 10-year bond has a longer duration than a 7-year bond, and the 7-year bond has a longer duration than 5 years, right? Just like the duration of a flight, how long until that bond lands and you get your money back. So the longer it is until you get your money back, the more duration risk there is. And the reason that causes risk is, you know, that let's just say 8% junk bond sounds attractive today, but if 6 months from now, U.S. Treasuries of the same duration are paying 8%, well, who wants to have that bond from a junk bond, a junk company? Nobody wants that, right? We'd all prefer that the U.S. government was issuing that bond, because there we don't have creditor risk, right? The U.S. government owns the printing presses, so we know we're going to get the return of our money. But it doesn't mean that a 10-year U.S. Treasury bond is risk-free. It still has that duration risk. So if interest rates were to rise by 1%, you're giving up 1% a year over 10 years. So, you know, if there was no time value of money, that bond would drop in value by 10%. In actuality, it's probably going to be closer to 7 or 8%. And a 30-year bond could drop, 22% because of duration risk. Again, no creditor risk because it's the US government. So those are two major risks that I want you to be aware of, right? So if putting your money in bonds of large, let's say Fortune 500 companies is not a lower risk activity, what is? I think like 30-day or 2-year treasuries, again, these are bonds, this is debt issued by the US government. Those are very low duration. You have no creditor risk. So that's one way to get that. And right now, 2-year treasuries, as I record this, is paying over 4%. You know what else is also paying over 4%, actually closer to 5%, is money at your local bank. A lot of banks are paying close to 5% as I record this. And as long as you're at an FDIC insured institution, an FDIC insured bank, and as long as you're below your FDIC limits, then you have very, very little risk. I'm sure you could come up with a scenario where maybe you'd lose access to that capital for a short period of time. But in theory, if a bank fails and it's insured by the FDIC and you're below the FDIC limits, you should get access to your capital very, very quickly. So money in an FDIC insured bank that's below the FDIC limits is also going to be low risk. And another thing that's going to be relatively low risk, but not without risk, are money market funds from high quality institutions. I don't want to mention specific names because that's outside of the scope of this video, but know that money markets can, very rarely, but they can do what's called breaking the dollar. And I do think you want to be aware of that. So you want to make sure you can look up online what the holdings are of money market funds. And you have the creditor risk. So what are the underlying bonds? And they tend to be secure. They tend to be from the U.S. government. So 7-day paper from the U.S. government, things like that. So tend to be low risk tools, both creditor risk and duration risk, but you can look up what those holdings are. And if the holdings are longer term, there's going to be more risk. Or if the holdings are outside of the US government, there's going to be more risk. The other thing that I've had some people ask is, hey, Asul, what do you think about money markets in foreign countries? And boy, there you're taking exchange risk, right? You're taking the risk that currency might actually weaken. So the interest rate might be attractive, but because of local inflation or whatever factors, the return of the money when you translate that back to US dollars could be lower. So, simplicity is more powerful than complex. Don't let yourself be talked into something complex. The other thing is, I think it makes sense to work with a professional. None of this is financial advice. I don't know your situation. I encourage you to work with a fee-only financial advisor. You can find one just by Googling that term. And then I also encourage you to watch this video up here that talks about 8 things that as you start to approach retirement age, I think it's time to stop doing in order that you enjoy the journey more. Thanks for watching this video. Bye-bye.